Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about the Wendy'S Company annual report. The Wendy's Company operates a system of quick-service restaurants globally, offering a wide range of menu items. Their restaurants provide various services including hamburger sandwiches, chicken tenders, nuggets, chili, French fries, baked potatoes, salads, soft drinks, and frosty desserts. They also offer kids' meals and a breakfast menu featuring the Breakfast Baconator sandwich. In addition to food services, the Wendy's Company owns and leases real estate properties, indicating their involvement in property management. This diversifies their business operations beyond just providing quick-service restaurants. With over 7,397 locations worldwide, including 5,969 in the United States and 1,428 internationally, they have a significant presence globally. The company's services can be summarized into several key areas. Food services, including menu items such as burgers, chicken, salads, and desserts. Property management through owning and leasing real estate properties. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what might cause a company's stock price to crash. The stock price of a company like Wendy's Co. can crash due to various reasons. One major factor is poor financial performance, such as declining sales and revenue. This can be caused by a range of issues including ineffective marketing strategies, poor product offerings, or increased competition in the market. Another reason for a stock price crash is changes in leadership or management. A new CEO or management team may implement policies that are not well received by investors or customers, leading to a decline in stock value. Additionally, external factors such as economic downturns, regulatory issues, or negative publicity can also contribute to a company's stock price crashing. For example, if a major competitor opens a new location near one of Wendy's restaurants, it could lead to a loss of sales and revenue for the company. Lastly, changes in consumer preferences and trends can also impact a company's stock price. If consumers begin to favor healthier or more sustainable options, and Wendy's is not able to adapt quickly enough, it could lead to a decline in sales and revenue. In summary, there are several reasons why a company like Wendy's Co. might experience a crash in its stock price. These include poor financial performance, changes in leadership or management, external factors, and changes in consumer preferences and trends. The Wendy's Company market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. The Wendy's Company trades at a lower price-to-earnings ratio of 8 times and a higher price-to-book ratio of 11.64 times relative within the industry. Despite the industry trading at relatively low valuations, the stock matrix does not show much. Investors should evaluate if the business has potential earnings that is sustainable and if the assets are valuated rationally. The company exhibits a very high leverage profile, with liabilities accounting for 98% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count while revenue has grown, but declining assets and equity suggest buybacks may be taking precedence over reinvestment. The company have a dividend yield of 7.8%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through an analysis of various financial metrics. On the positive side, franchise royalty revenue increased by $71,740. Advertising funds revenue rose by $36,584, and sales at company-operated restaurants grew by $27,019. Additionally, rental receipts from transactions with QSCC increased by $289 in 2025, while Tim Wen lease and management fee payments also saw a significant increase of $21,033. Royalty income from Yellow Cab rose by $15,197. On the other hand, some revenue streams experienced decline or stagnation. Wendy's U.S. Revenue decreased by $74,621 from 2024 to 2025, while advertising time purchases from AMC decreased by $800 in 2025 compared to previous years. However, it is worth noting that these declines were largely offset by the growth in other areas, such as franchise royalty revenue and international revenue. Overall, the data suggests that a combination of factors contributed to revenue growth or decline, with some segments experiencing significant increases while others saw decreases. Net income for the company decreased significantly from 2023 to 2025. In 2024, net income was $355.3 million, but it dropped to $344.5 million in 2025, a decrease of $10.8 million, or 22.2%. This decline continued into 2025, with net income decreasing by another $29.3 million from the previous year. The profit margins also suffered during this period. The operating profit margin decreased from 16.5% in 2024 to 15.8% in 2025, while the gross margin increased slightly from 64.9% to 63.6%. However, the net income margin took a bigger hit, dropping from 8.7% in 2024 to 7.6% in 2025. The reasons behind these changes are largely due to external factors. The company faced increased commodity costs, rising operating costs, inadequate insurance coverage, and risks associated with international operations. Additionally, higher construction, occupancy, food, and labor costs in new restaurants further contributed to the decline. Commodity price volatility and foreign currency fluctuations also had a significant impact on the company's bottom line. Overall, the combination of these factors led to a decrease in net income and profit margins for the company from 2023 to 2025. The company's financial performance is a notable aspect of its overall health. One key indicator of this is the generation of positive operating cash flow. This means that the company is able to generate more cash from its core operations than it spends on various expenses. According to the provided information, the company has consistently generated positive operating cash flow in recent years. In 2025, the company reported $344.5 million in operating cash flow, while in 2024, this figure was slightly higher at $355.3 million. These numbers demonstrate a strong ability of the company to manage its finances and generate sufficient cash from its core operations. The confirmation of positive operating cash flow is also supported by specific numbers on page 65, which show that the company's operating cash flow for the year ended December 28, 2025 was $344,543, and for the year ended December 29, 2024 was $355,307. These figures further reinforce the conclusion that the company is indeed generating positive operating cash flow. The recent analysis reveals a mixed bag of performances across various segments and regions. On the negative side, Canada and international regions outside of the United States have shown poor results. These areas failed to meet expectations, indicating potential challenges in these markets. In contrast, new product development has been a standout performer, demonstrating strong growth and success. This segment's performance suggests that Wendy's is on the right track with its innovation efforts. It is worth noting that there is limited information available about regional performance, making it difficult to draw comprehensive conclusions. However, the data does indicate that certain regions are struggling, while others are thriving. Management's outlook for the company is centered around several key strategies. The first priority is expanding the food safety and quality assurance platform through digital platforms, which will provide a seamless user experience, enhance customer relationships, and meet consumer demands for customization, speed, and convenience. In addition to this focus on technology, management emphasizes the importance of building a people-centered culture that supports financial performance and global growth. This includes prioritizing employee safety and well-being through initiatives such as fostering a culture of people safety awareness and offering paid sick time. The company's business strategy also involves driving average unit volume, sales, and share growth through Project Fresh, which aims to revitalize the brand, improve operational excellence, optimize systems, and allocate capital effectively. Management recognizes that retaining key personnel and effective leadership is crucial for success, but acknowledges the risks associated with losing senior leaders or failing to adapt to technological changes. Furthermore, management highlights the importance of digital commerce strategies, including investing in new technology, predicting consumer acceptance of new tech, and mitigating competition from better-resourced competitors. The company also emphasizes its focus on cybersecurity risk management, regular reviews, and updates to ensure it addresses changes in business operations and the evolving threat landscape. In terms of financial outlook, management notes that inflationary pressures will continue in 2026, with anticipated labor and commodity inflation. To manage this, the company plans to implement selective menu price increases, product mix adjustments, and operational excellence initiatives. Overall, management strategy is centered around leveraging technology, prioritizing people-centered culture, driving business growth through Project Fresh, and mitigating risks associated with leadership changes, technological disruptions, and inflationary pressures. The company's financial activities have been marked by a commitment to returning value to its shareholders. One key aspect of this is the payment of dividends, which has been consistently practiced as evident from references on pages 23, 43, and 101. This demonstrates a clear intention to distribute profits among investors. In addition to dividend payments, the company has also engaged in share buybacks. This strategy allows the company to reduce its outstanding shares, thereby increasing the value of each remaining share for existing shareholders. The presence of references on pages 30 and 44 confirms that this practice is indeed a part of the company's financial operations. These actions collectively indicate a proactive approach by the company towards enhancing shareholder value through both direct distribution of profits, dividends, and strategic reduction of its equity base, share buybacks. Supply chain concerns loom large. The possibility of supply chain disruption is a pressing concern for businesses. Unforeseen events such as natural disasters, hostilities, and health epidemics can significantly impact consumer spending, restaurant sales, and operations. Furthermore, climate change and its associated effects on energy and water resources may lead to increased costs. Shortages or interruptions in perishable food product supply could damage brand reputation and harm business. Disruption of service from key suppliers or distributors can also increase costs and negatively affect the bottom line. Additionally, disruption of service from inline distributors can result in short-term increases in costs. These potential disruptions highlight the need for businesses to be prepared and adaptable in the face of uncertainty. That concludes the financial summary for the Wendy'S Company. Feel free to comment below, and I will be happy to answer them when possible.